Well, when you get a chance to meet a galactic viceroy and he tells you the end is not near, you have a few options at your disposal. One, you can try to wake yourself up from that dream you're having. Or two, you can swear off late night sci-fi movies. But I'm going to choose three. The option here I'm going with is you can simply realize you're in the presence of the one and only Chuck Yates and go with the flow. So I'm really not sure what I should be calling you. Chuck, Sire, maybe just go with Fatty.
Your Highness. That's so funny. That was such a split second thing on LinkedIn because they make you put a title in. And right. I'm sitting there going, unemployed dude just doesn't sound very good. So I typed in Galactic Viceroy, didn't even give it a second thought. I kid you not, someone direct messaged me, congratulations on the new gig. And I was like, okay. And I'm sure they just hit the button, right? So I was a little bit of a smart aleck and texted back, thank you so much. I'm just pursuing my dreams. And I kid you not, they texted back, I know you'll crush it. I know you'll do well. And I said, now, in fairness, that person's probably running around telling everyone Yates is crazy. He thinks he's really an empire out in space.
Well, you know, people are going to think what they think, but seriously, we're glad to have you here because you always got great information for us and usually have a different take. And obviously, we're looking to hear what you have to say. And I mentioned in the beginning about talking about the end is not here because Chuck's going to discuss that notion. The loss of value doesn't necessarily mean the end for an industry. We'll talk about the shell bubble. Oil stocks may be down, but they're certainly not out. So Chuck, why don't you just tell us what's going on? Why is the end not near for this industry?
Lynn, really appreciate you having me in, and to all of Hart's for having me in and letting me share this with you. I think this is kind of a culmination of 5 or 6 years out fundraising, talking to investors, reading the Wall Street Journal, reading narratives and things. And what you hear, and this is a bit of an oversimplification, but it's something to the effect of prices crashed, value was destroyed, that's the end of the industry. And I think that conflating the two is an oversimplification of things. And I think it's important we put it into a framework so then that can give us some insight into maybe how to look at energy. And so what I'm going to say, just pure, simple, easy, the shale revolution was a financial bubble. It's as simple as that. And, you know, let's spend a little time talking about what a bubble is. I think everybody generally knows, but what a bubble is when you have a rapid increase in value of an asset class, generally speaking, above and beyond what the asset class is worth. You know, you get people basically paying more for assets because they think they're going to sell for more, not because fundamentally this asset is going to be worth more in the future. There have been a lot of bubbles historically. You can read about the South Sea Company way back in the day. Everyone knows about the Dutch tulip bubble. There was a whole issue with railroads in the mid 1800s. In England, but I'm going to spend a little more time talking about bubbles just to give some stages of it. But what I want to do is I want to actually talk through the .com bubble because a lot of us lived through that one, and we'll use that as some parallels to how we think about energy these days. And so there's an economist named Minsky who has written a lot about bubbles. He's got 5 different stages. I've read different articles saying there are 4 stages, 3 stages. I'm going to mix it all together. But the simple thing is at the start of a bubble, there's a trigger of some sort. There is a new technology. There is a new way to look at the world. There's something exciting happen that's going to dramatically change something. And then what happens around that is there's a lot of ambiguity. Exactly what can this technology do? Exactly how can it change things? And it's very easy to manipulate the ambiguity to justify inflated prices for the asset class. Generally in that trigger phase, for it to turn into a bubble, there needs to be some successes, right? Somebody needs to go out and use the internet and make a ton of money and really change an industry. Somebody needs to go out and use what we're going to talk about, horizontal drilling, fracking, to drill a much better well. But there's something that leads to these initial successes. Then you get into what they talk about is awareness. You get knowledge of price increases, you get into speculation. There's a next stage, some call it boom, some people call it irrational exuberance. This is usually when bartenders turn into landmen and go out and buy acreage from Farmer Bob in the Permian Basin. And then ultimately there is a crash. And the crash is the rapid decline in prices that we all see. What's interesting is all the academics who have studied crashes, they come back and they say it's rarely a single event that causes the crash. It literally is someone starts selling and then people are selling for the sake of selling because others are selling. And so where maybe the buildup to the bubble is an optimistic feedback loop of we're buying because things are going to go up, the reverse happens on the downside. It's we're selling because others are selling. So there's a really, really interesting historian named Brian McCullough who writes about the internet. And he uses, and I encourage everybody to go look up his work on the .com bubble because it's fascinating. I'm gonna hit some highlights of it. But his poster child for the .com bubble was Priceline.com. We all remember those commercials. And at the beginning, the business plan was pretty simple, right? There were 500,000 flights a day, or 500,000 seats on airplanes that were going unsold, right? And the airline had inventory that wasn't being used. So he created a website so that consumers could bid on those seats that were otherwise be empty. It was a win-win all around. Customers got cheap airline tickets. Airlines got some money for what otherwise would have been a zero, and the business took off. So from its founding in April of 98, they went from 50 employees to 300. By the end of 99, they were selling 1,000 tickets a day on airlines. They had plans to go to hotels, car rentals, apply the business model there. And really, at that point in the .com bubble, and they were the poster child for it. Remember all the William Shatner commercials and the like about Priceline? The whole business approach in the .com era was spend dollars on advertising, capture the land or the space, if you will, and then the business was all yours. And so every venture dollar they raised, IPO dollars, heavy advertising. So Priceline went public March of 99. They IPO'd at 16. At the end of that first day, they closed at $88 a share, which valued the company at almost $10 billion. And what's interesting is all of those dollars that were being spent by the .com companies, there was a poll run in the late 90s. And the question was, who has the stronger brand? Number one, Coca-Cola, or number two, Yahoo? Coca-Cola won, but just barely. Can you imagine that a 125-year-old, 150-year-old company that might be the single greatest advertiser the planet has ever seen, the 70s of I'd love to buy the world a Coke, the like, they're the first people that actually back in the 30s introduced fat, jolly Santa Claus in a red suit. I mean, just a phenomenal marketing machine that's been around forever, almost the most popular consumer product on the planet. Yet Yahoo had almost the same amount of brand and it had been around for 4 or 5 years. So that was kind of the stunning amount of money that was being spent on this advertising during the .com era. It's funny, there was a joke back then that these companies that had a grand vision of a more efficient way of doing business were all unprofitable, was the joke on the side. But to kind of take this .com bubble, the amount of money that was being spent, let's talk about the peak. In October of 99, the market cap of 199 stocks that were tracked by Mary Meeker, and Mary Meeker was literally the best internet analyst, Morgan Stanley. I mean, she was far and away the big dog when it came to the internet. 199 stocks she followed had a market value of $450 billion. Their annual run rate of revenue was 21 billion, and they had collective losses on a run rate of about $6.2 billion. So January 14th, 2000, the Dow Jones Industrial Average almost hits $12,000, or almost hits 12,000. That's its peak. It wouldn't return there for almost 6 years. March 10th, 2000, Nasdaq just over 5,000, wouldn't return there for 15 years. So literally by the end of April 2000, a month and a half later, it had lost a third. The Nasdaq had lost a third of its value. It hit its bottom on October 9th, 2002, just over 1,100, which is down 80% from the peak. So if you look at that and the great fall in the dot-com bubble, CNNFN.com calculated that $1.7 trillion of value was lost in the dot-com bubble. You know, Silicon Valley lost 200,000 jobs during that time. More than half of all internet businesses actually failed during that time. So that's your bubble in the dot-com world. But before I give you some lessons there, let's go to the railroads in the 1840s in Great Britain. And so back then, railroads, disruptive technology. Everyone was building a railroad everywhere. Someone calculated up that every railroad project that was proposed and being built, for all of those projects to just break even, every citizen of Britain was going to have to ride a railroad 12 hours a day just to break even. 90% of all of the railroads in Great Britain, so all across that island, 90% were built during that period. And one of the Rothschilds actually said, my single favorite investing quote of all time. The Rothschild said, there are 3 roads to ruin: wine, women, and engineers. The first 2 are more fun. The last one is the most certain. And you know, I always get a big chuckle out of that. But phenomenal amount of dollars were lost in Great Britain on the railroads. But here's the important lesson of the bubble. The railroads didn't go anywhere. The next day, after all of that money was lost, the railroads were still there. And because the railroads were still there and there was cheap capacity on those railroads, that led to the Industrial Revolution that Great Britain enjoyed. So let's bring this back to the dot-com bust and look at the carnage there. What happened, the telecom companies raised $1.6 trillion worth of equity and $600 billion worth of debt, and they crisscrossed the country with bandwidth. We laid fiber optic everywhere. 80 million miles of fiber optic were laid during the dot-com era, which basically quadrupled the amount of fiber optics we had in the United States. So what happened? We wound up with a severe overcapacity of bandwidth. There was a 90% drop in the cost of bandwidth during that period. And even as late as 2005, 85% of the bandwidth in the United States wasn't even being used. Bad? Yes. But the flip side of that is that cheap bandwidth led to any sort of app, website, business you wanted to start online was so cheap and so affordable that we all saw what happened, right? Today we use Amazon all the time. And so just to kind of put some stats around that, in the year 2000, 400 people were online and there were 17 million websites. In 2010, just 10 years later, 2 billion people were online and there were more than 200 million websites during that time. That is what the cheap capacity did for technology and those businesses. Just like the railroads, they provided a benefit later. So I think it's important when we look at these bubbles, we see that value destruction did not equate to the end of a business. I mean, we all use the internet today. And so how foolhardy would we be to say, oh, just because everybody lost $1.7 trillion, nobody's going to use the internet again today. So what I thought I might do is just tie this back to oil and gas. And all of us know oil and gas that are listening to this. And so you've already done all this in your mind. So I'm not going to belabor the history of the shale bubble because you've already done it, right? But what was the trigger? Horizontal drilling, modern fracking. I'll put a nuance on that it being the new technology. I actually think those technologies have been around forever. I mean, if you think about it, we drilled our first horizontal well in the United States in 1937 offshore. John Wilkes Booth, who shot the president, do you know what he did besides being an actor? He actually paid for his acting career by being a fracker. He threw dynamite down wellbores to stimulate them. And so, yes, fracking did kill Lincoln, unfortunately. But at the end of the day, these are technologies that have been around. It was really $5, $6, $7 gas, right? That gave people cash flow as well as the incentive to go utilize these technologies. So we did that. There were obviously early successes. I think the knowledge that came and really the belief was less, we're going to buy this because it's going to be worth more later. I think actually what became the compelling reason that people were buying is bigger fracs will lead to bigger EURs. Every time we increased sand, water, stages, it got better. And everybody out there has already done this in their head, but they've equated dollars per eyeballs on websites back at .com to dollars per acre and the like. So clearly we can see the bubble. We saw the early enthusiasm. We saw the dollars rush in. We could go through fund flows and we'd see all that. I want to point out one last thing though, before we jump into kind of the conclusions and what we can learn from this bubble is what's unique to oil and gas is every asset an oil and gas company buys, whether it's a property or a piece of acreage, if you think about it, they are the person that valued that the most on the planet, right? I mean, the high bidder wins out on your cost of goods. It's a little bit of a different dynamic. A shoe company drives down their cost of goods by being able to have mass economies of scale, et cetera. By definition, the most optimistic, the person that thought the most of this acreage is the one that was the buyer of it. So you had a system where all this money's rushing in and literally the money is going to the person that's valuing the cost of goods the highest. And so we understand why things underperformed. And I think that's actually not trying to be a homer for the industry, but somewhat deferential. People were not doing this just for the sake of doing it. They truly were optimistic that this was going to work out, paying prices they felt like they could justify. Because the early lesson from the shale boom is if you didn't believe in bigger fracs, you didn't capture any assets, you didn't have any successes going forward. So let's go to what's left today. We've seen the bubble collapse, right? We've seen the deflation. If we step back, January of 2020, we were at about 100 million barrels a day of oil used worldwide. Supply and demand pretty much in balance. I would have told you that oil was going to be at 75 or 80 by now. COVID comes, slaps, 25, 30 million barrels a day of demand out of the system. We've since come back. Where are we now? I'm not exactly sure, but let's say we're at 90 million barrels a day of supply and demand, and OPEC and the Russians have, call it 8 to 10 million sitting on the sidelines there. That's still, if you think about it, 90 million barrels a day, that's $4.5 billion a day. That's a really, really big industry. And if you think about that demand, and here's where people have been going, they sit there and they say, value is lost, no one's going to use oil in the future. That's just not true. There are 300 million internal combustion engines in the United States as we speak. There are 1.2 billion worldwide. Do you know how many of those 300 million cars are going to be on the road in 10 years? Probably all of them. We build really good cars these days. When's the last time you ever said, man, I got to trade in my car. That internal combustion engine just doesn't work anymore. They run forever. So just because you turn in your car and get a Tesla doesn't mean that that car goes away. It's someone else is driving it. And so if we look at the US kind of pre-COVID, we sold about 7 million cars a year. 6 million of those cars were $40,000 or less. So the electric vehicles are going to have to make big inroads there. But let's say let's say they're half of the market for the next 10 years. So 10 years from now, we're going to have 335 million internal combustion engines driving around the United States. And we're going to have 35 million electric vehicles driving around the United States. To think that oil is going away is just crazy. It's ludicrous. Boeing, Airbus, planes, airline fuel, 21% of all oil use. Sure, COVID whacked the travel business. We've all seen that. Is it going to return? Yes. The second I have immunity, I'm on a plane and I may never get off. So yes, that's going to come back. Airbus and Boeing, they don't even have patents on an electric plane, right? It's not like they're at a prototype stage and boy, we're going to be right there as soon as these work. So what I would say to you is peel the bubble back. Look at the lessons of the railroad bubble in England. Look at the dot-com bubble, and let's draw our conclusions about oil and gas from that, and not from conflating everything together saying, oh, value was destroyed, therefore it's over. Real quick, I'll give 3 conclusions that I think are all reasonable. And I think very savvy investors will look at the energy business through one of these 3 lenses and will be able to make money off this. We can look at railroads and .com and we can go spare capacity means cheap product. I think that's very valid to look at. We can say there's 10 million barrels a day sitting in OPEC on the sidelines. You can make the case that US shale is cheap to put stuff online and can immediately do it. Therefore, we're going to have cheap energy for 10 years. That may not be good for oil and gas companies, but a savvy investor can say cheap. Okay, what's going to benefit there? Amazon. Amazon is delivering stuff to our house. Gasoline's probably their 3rd largest cost because they're flying planes around, they're dropping stuff at your doors. Okay, maybe I go invest in Amazon. You can think through the bubble, look through the wreckage, and say we're going to have cheap fuel for the future. Also means you better be careful on buying those electric vehicle stocks, because at the end of the day, cheap oil means you're not going to go buy a Tesla and pay $150,000 for a Tesla when you can buy a cheaper Cadillac that, and you're putting gas in your tank for $1.50 or $2. Second conclusion that maybe someone could draw, and this is the flip side. You could say the bubble collapsing and the value destroyed has starved the industry of capital. There is no external capital coming into the industry. And the whole reason the bubble collapsed is the returns weren't there. They did not drill as good a wells as they said they were going to. In fact, they didn't drill wells well enough to even be able to maintain their value. Because the industry is starved for capital, because oil is a depleting asset, you could take the counter side and say, oil prices within 2 years have to be at 100 because there's not enough supply to keep back up with demand when we're all done with COVID and we're all flying around. Again, I think a valid conclusion you can draw and go study with. The third that I'll throw out there and end with is what happened after the dot-com collapse? Did technology go away? No, they morphed business models. They changed business practices. They focused on generating cash flow, self-financing. They stopped spending foolish dollars on advertising and instead created real ways to deliver products to consumers cheaper. That's why we have Amazon today. That's why we have technology, Facebook, all of the like, is because they morphed business models to do this. And so I would say what's happened in our oil and gas business in the United States, we've gone from the age of the driller to where we supplied the marginal barrel for anyone who wanted one on planet Earth, to today we don't need that. So we're producing. It's the age of the plumber. I stole that line from Tommy News, formerly of Oasis, so I need to give him credit. But within the age of the plumber, there is a whole host of things that we can do to that business to make it better. Technology is going to have such a run in the oil field, literally squeezing nickels and dimes out of the system, that there's a lot of money to be made. So just let me close by saying this. At the end of the day, bubbles happen. Shale was a great bubble. By the way, I'm in downtown Richmond, Texas. That's my train coming by over here in the back. The most passive-aggressive engineer on the planet is sitting there passing by. So oh, there you go. My screen flies off. So anyway, passive-aggressive engineer in the train didn't like what I said about the bubble in the 1840s, but there's going to be a massive opportunity for technology because we've morphed business models within our industry. So kind of with that, I'll stop and again reiterate my thanks for letting me come and speak.
Right. Well, no problem, Chuck. I think that engineer was a little bit upset about the British railroad example you gave. So
exactly.
Say, look, I got a couple questions here for you, and
Sure.
one I'm going to steal from our friends over at Energy FinTwit. I saw one of them post this morning. So, so no, it goes back to what you're saying about EVs. So we got, do you think people will recognize that investing in the post-bubble shell is better than the new bubble EVs? I mean, is that really something we're going to see, or people running to just another bubble? Is that?
That's really interesting, and that's the hard thing, because when I started writing this speech, I really started spending a lot of time going, I need to find some research that defines what causes the bubble to burst, because I can run around and point to a lot of what I think are potential bubbles. I think every business on the planet in normal times of normal GDP growth, when they're fairly mature, should trade at 4 to 6 times EBITDA. You got a lot of CapEx, maybe you're 3 to 4 times EBITDA. You have little CapEx, maybe 6 to 7. There is no way Tesla will ever generate enough EBITDA to justify its current valuation. So you go, clearly that's a bubble. To your point, we've gone from the oil and gas bubble to now the electric vehicle bubble to potentially what's going to be the energy transition bubble, as a lot of money heads that direction. The key for investors is figuring out, though, what is going to cause the bubble to burst. And with Tesla, I have no clue. Right. And I would have told you billions and trillions ago that the bubble would have already burst. So I think you're absolutely right. We're definitely going from bubble to bubble. I would definitely do it with caution. The one thing the research shows on bubbles is there's definitely a time for profit taking. And when you take profits and you sell, you want to feel really bad that you left money on the table. That probably means you sold at the right time.
Yeah, certainly. As I said, I got that from Energy Cynic, I think, put it up. So give him the credit.
There we go.
Yeah. So you talked a lot about how the business model will change. I mean, what do the guys or people in the industry in oil and gas need to do to change, to keep that money, to keep people interested in investing in getting those nickel and dimes out of there? So.
Yeah, it's interesting because I think, and I've said this before, so I won't belabor it, but I've always said oil and gas, we ran our business like we were holding lottery tickets. The Saudis could do an embargo, oil prices triple, we're rich. You could, early days of oil and gas, you could hit a big well, you're rich. Late 90s, 3D seismic, all of a sudden we can image a bright spot, boom, we hit it, we're rich. And we've always spent money creating the best technology when it comes to giving ourselves more lottery tickets. But at the end of the day, we've never spent a dime or any time, energy, and effort or applied any technology to things that don't give us a lottery ticket, but in effect can save those nickels and dimes. I'll give you examples. Our land files. We have drawer after drawer of paper land files that should all be digitized and searchable, correct? We map on paper. We keep our accounting literally in a handwritten ledger. I'm being flippant here, but at the end of the day, that those saving the nickels and dimes there did not give you another lottery ticket. Today, it's different. There are no lottery tickets in front of us. Yes, we may have higher prices, and that might be the only one, but there is no mystery shale that is going to pop up on your acreage. There's no technology I see staring in front of us that could have any sort of material change to our business. And so I think for the first time, oil and gas companies and executives are having to look at those nickels and dimes. And unfortunately, business school 101 teaches you the way to drop costs is to automate. And I hate that from the human side of it, because I don't want to see people lose their jobs. But there's probably 75% too many people operating the assets we have today in oil and gas companies. So it's consolidation, it's technology, it's automation. Do we really need a pumper driving by every well every day? Could we put artificial intelligence on those wells, monitor it that way? So I think that's what I see as we move into this age of the plumber. We're going to be producing, we're going to worry about nickels and dimes. Just think about it this way. If you can match up your hedging, and instead of being, I guesstimated my production and I was about 60% hedged going forward, if you could get really precise about it and be 75% hedged, and literally your hedges protect you, that might be the difference between bankruptcy or not. And those are the stakes today, and those are the razor thin margins we're playing with. So I see a huge opportunity for technology to do a lot in the way of automating there.
Okay. I was really interested because, I myself am somebody who likes to look back at historic events and figure out how it relates to today. But when you talked about the likes of Amazon coming out of that cheap bandwidth that was laid down from fiber, any guesses? And I'd actually really like to hear what our commentators below us might be saying about this. Who benefits from that infrastructure laid down from the shell bubble revolution, whatever we want to call it? Any guesses there where we go? Who gets the benefit of that?
I mean, I think you can make a case. I'm not saying I believe it, but you can certainly make a case that all of the dollars in the excess capacity means cheap energy, right? Mm-hmm. You're going to have cheap oil. So who uses oil? Airlines use oil. Amazon uses oil to deliver. FedEx uses oil. So you can, the quote unquote beneficiaries of that excess capacity, cheap oil. And, anyone that's using oil, and oil is the big fuel in the world. It's about a third of all energy usage on this planet. It is GDP. It's 90% of transportation fuels. It is petrochemicals. I mean, the manufacturer of polyester is going to benefit from cheap oil. So the excess capacity argument, like the trains being there, like the bandwidth just being there, is cheap energy. I talked a little bit about this, but the flip side to that is if we're going to starve an industry of capital and it's a depleting asset base, the flip side could be true as well. We don't have any excess capacity. In fact, we have excess demand. And I think an investor could reasonably look at the dynamics today, make some assumptions about demand post-COVID, and say, well, it's going to be at $100 in 2 years. And so short answer is, I don't know. I've never been good at predicting prices. I always had one CEO that would say, Chuck, what do you think oil prices are going to do? And they would hedge the opposite way based on what I said. But I think that's the lens you need to be looking through as an investor, instead of just throwing up your hand saying, well, energy's going away.
I think a lot of us are in that boat. I don't think a lot of us can figure out why oil prices are going which way. Okay, well, I'll leave it at that. But I do want to say I think we may have given the keep it in the ground people a little bit of a new argument because I didn't know fracking killed Lincoln. So I fear that's the headline we're going to make out of this.
Fracking killed Lincoln.
There, see what fracking did? It killed the president. So anyway, Chuck, really good having you again, and I'm sure we'll see you again. And we'll talk to you soon.
Really appreciate the time, and make sure everybody tunes in Friday night on Twitter for Kenny Lay's Roll Call.
Yeah, roll call. And what about, you want to plug your podcasts?
Sure.
So,
no, I appreciate that. Chuck Yates Needs a Job, the podcast. Also the website, chuckYatesNeedsAJob.com. I'm on the Digital Wildcatters platform, so you can access the podcast there. Got some good stuff coming up next few weeks. We're going to have a 2-part series with Energy Credit. One who actually reveals his true identity on the podcast, which will be pretty neat. We've got Chad Spencer, who's placement guru to the stars, comes on and gives a lot of good advice for folks that may be out of a job today. And then the anonymous character on Twitter, Bomber, is going to come on. And so that'll be kind of the next 3 or 4 weeks. But at the website, we've got all the old ones, including Greg Kane and Buddhagate. Last week we had Katie Maynard of Ally, Pink Petro, and so it's been a lot of fun doing that, and I appreciate you letting me talk about it.
No thing. That's no problem at all. Somebody's going to reveal themselves. I gotta get on that. So we'll look forward to it. Keep at it. Chuck, thanks again.
Appreciate the time. Thank you for letting me join.